Ed, I thought, there we go. Thank you. Good morning, Cornell on radio. Ed, I want to go to the Krugman essay last week where he destroyed monetarism and said simply it was a theory then, it's not now. What should we do with our collective memory of the ghosts of the 70s, the theories of Milton Friedman?
Well, I think he was right up until the pandemic. We did see a tremendous amount of quantitative easing, zero interest rates. Central banks provided a tremendous amount of liquidity. And yet there were some very powerful forces that kept inflation down. Disinflation was the law of the land for many, many years following the great inflation of the 1970s. It was things like globalization and technological innovation, aging demography, and too much debt that all were fundamentally disinflationary. But the pandemic changed all that because it really put monetarism on steroids and speed in the form of modern monetary theory. We just had this unprecedented increase in government debt deficits, and all of that was to a large extent financed by the central banks.
Help us with a distance here from Dartmouth College and David Blanchflower, Hanover, New Hampshire, and the University of Cambridge and Dr. El-Arian. They are polar opposites on the inflation guess. Where do you stand on that?
Well, I think inflation is persistent. Obviously, the word transitory is no longer allowed in our conversation, according to Jay Powell. So persistent. I think it's going to be 4 to 5% for the consumption deflator until the middle of next year. And then I think it does ease back down to 3 to 4%. I don't think it's going to go back to 2% anytime soon. And I will not be surprised if the Fed deals with that by raising the Fed funds rate by maybe 2, maybe 3 times. But I think they might also seriously consider raising the inflation target, moving the goal from 2% to 3%.
Ed, so a lot of people are looking at a Federal Reserve that is so responsive to market turmoil that basically if they do signal that they're going to raise rates next year and there is some sort of tantrum, they'll step in and ease some of the conditions. How much is that anachronism at this point, given that there's a very different paradigm?
I think it is. You're absolutely right. It's a different paradigm, and we've had 4 taper tantrums since 2013. We had one in May 2013, and then we had another one in early 2016, one in right before Christmas on 2018, and then this one is a work in progress. It's not clear just how it's going to play out, but I think that the big difference is this time around the Fed can't give the market what it wants, which would be okay, back off, don't taper so much, simply because the inflation problem is real, and the Fed has made it very clear that they are now concerned about it. So it's going to be pretty hard for them to back off.
Although I do notice in the data, there's been a real shift over the past few weeks, that people are bringing down their longer term expectations once again for inflation. It seems as if people are convinced that a Federal Reserve hiking rates in the near term will allow growth to revert to something similar to what we've seen in the past, albeit possibly even lower based on the demographics you're talking about. Is that a reality in your perspective? Does this give them leeway to hike a couple times, let it go, and actually have a smooth exit?
I hope so. I think that's the consensus view. Maybe it's wishful thinking. Maybe, the pessimism about the near term is being offset by the perception that the pain now will lead to gain later. Look, first and foremost, I don't think this is going to wind up to be like the 1970s. There's some aspects of that going on right now, like a wage price spiral, which is of concern. And we're already seeing some cost of living adjustments being put into contracts. But I'm a big believer that productivity is making a huge comeback. And the reason for that is one of the huge differences between now and the 70s is there's no growth in the labor force, and that's related to demography. And companies are just going to have to increase productivity to offset the fact that the labor shortages are not temporary, they're chronic.
And Yardeni, I want to go to your book, and I want to say it is a triumph to Megan Desai of the London School of Economics, where Ed Yardeni, folks, writes in praise of profits, and you begin with the great David Ricardo, who changed how we think. And this underestimation of profits, is the profits now for technology different than the profits of December of 2000?
Absolutely. I mean, in 1999 and 2000, a lot of the profits in technology were based on dot-com companies who had really no serious business plan, ordering technology and paying for it with credit. The big situation back then was that you had telecom companies seller financing their customers. So those profits were kind of phony. And it was a period where there was a lot of manipulation of profits. This time around, these are very real profits. They're based on very real businesses. And I think technology is the wave of the future. It always is, but it's more so than ever.
How do you respond to the cry of 15 years that the profits are all going to a few?
Well, there is this kind of Marxist view out there that if a company is profitable, it must be exploiting somebody, and it's probably exploiting workers, and it may be exploiting consumers by not giving them the very best. But I make a distinction between two kinds of capitalism in my book, and that's entrepreneurial capitalism and crony capitalism. I actually am in the same camp as progressive socialists when I say that I'm against crony capitalism. Crony capitalism isn't capitalism. It's all about using the political system to game the system. I'm an entrepreneur myself, and I can't afford lobbyists, so I think that's really the definite distinction between an entrepreneur and a crony is whether you can afford lobbyists or not. I can't, and I've got to compete. I've got to give customers the very best. So in my book, I also argue that Adam Smith did a terrible job of marketing capitalism by telling us that it's all about selfishness. It's not selfishness. It's insecurity. I'm going to go out of business if I don't give my customers the very best of what I have.
I'm sure that that's a harder sell, that capitalism, go for it because it's based on insecurity. I do wonder, though, Ed, just going into the realm of trading, going into the realm of how you position in such a tenuous period, given that you do feel overall optimistic about productivity, but a little bit concerned about the Fed and how that all shakes out. Have we already priced in the dynamism in technology, the productivity gains that you're expecting, or do you think that that will fuel further gains in the headline indexes next year?
Well, look, I think the best is yet to come for us in terms of prosperity, in terms of standard of living. I think technology is going to solve a lot of our problems. It is solving a lot of our problems. Yeah, I mean, we're not going to get double-digit increases in the stock market anytime soon. Earnings peaked on a year-over-year basis in the second quarter, and that doesn't mean they go down. They just grow at a slower pace. So I'm predicting that we go from 4,800 by year end. So we're getting close, but no cigar just yet. And then something like 5,200 by the end of next year and 5,500 by the end of 2013. Those are not spectacular increases. They're single digits, consistent with single digit increases in earnings.
Ed, looking forward to giving the book a read. It's on my desk. Thanks for being with us this morning, buddy. Appreciate it. Ed Yardeni of Yardeni Research and author of The Praise of Profit. Thank you, sir. Your equity market up 62, advancing 1.35% on the NASDAQ 100, up by 1.9%. A really interesting market. Get to the bond market, 2s, 10s, and 30s. And look at 2s, up 4 basis points on further, 2s right now, up to 67 basis points this morning, Tom. And just a gap lower on euro dollar. If you get to an intraday shape of the chart of euro dollar right now, just a gap lower to 112.31, Tom.
And I have forgotten, John, did we get like over the last 20 days to a 111 handle?
We did. November 24.